The stock market has been on a massive bull run in the last 3 years, and 2025 in particular has been quite good as well, as we can see from the S&P 500 heat map. But despite this, in the midst of a huge bull run, the Fear and Greed Index is now in fear and getting closer to extreme fear. There's some concerns about President Trump starting up tariffs again. Now, in the midst of all this, we continue to see more Wall Street analysts put out price targets. If there's anything that Wall Street and investors in general love, it's price targets. In fact, we have entire websites like Tipranks, which I am a fan of. There's a link to it in the description, but much of their website is strictly dedicated to analyst price targets. We can see buy, hold, and sell ratings. We can see the average price target from analysts, but I personally have some major issues with price targets. Don't get me wrong, I love to look at them as much as anyone, but the vast majority of price targets are not done in a healthy way. For example, if we scroll down and look at some of these price targets, we get absolutely no context on how they came to these numbers, and oftentimes price targets are done in a very reactionary way. If a stock goes up, an analyst will increase their price target, and the opposite is true. If the stock goes down, they'll decrease their price target. That's not what we're trying to accomplish. And unfortunately, many people will issue a target with a 12-month forecast. That doesn't make any sense in my opinion. Why does that not make sense? Because in the short term, stock price movement is determined by sentiment, but over the long term, it's determined by fundamental growth. Now, like I said, I'm not completely against price targets, and in fact, there's a very straightforward way that we can approach this, which we're going to do in this video. We're going to be creating price targets for 4 different stocks, and I believe that all 4 of these stocks have the potential to double over the next 5 years. The goal of this video is not to take a deep dive into the business models of each of these companies, but to strictly look at the numbers, look at the valuation, and create a very straightforward price target that's backed by math. So let's dig into it, and we'll start by looking at Microsoft Corporation. Now, we can see right now, Microsoft is trading at $513.57 per share. If we look at them in the last year, the performance has been great. They're up about 21.5%, and year-to-date up 21.84%, so market-beating returns. Now, what's interesting is if we look at the stock really in the last 3 years, we can see, yes, they've outperformed the market, but they've already doubled in the last 3 years, up 123%. Which is why I think a lot of people have some concerns about the valuation. But here's what's really interesting. If we strictly look at Microsoft's price to cash flow ratio over the last 3 years, what do you notice? It's sitting at 28.06 right now, which is actually pretty much on par with what they've been trading at on average over the last 3 years. Now, how can that be the case? How can the stock increase by over 100%, but still be trading at pretty much the same valuation it's been trading at over the last 3 years? Well, the key is growing free cash flow and growing earnings. If we look at Microsoft on the stock screener, and you can see all the data is going to automatically load into my spreadsheet thanks to the help of the ticker data add-on in Google Sheets, which you can check out at the link in the description. There's a 7-day free trial. Now, when we look at Microsoft, look at the free cash flow from 2014 to 2024. It's grown at a very high rate. Now, 2025 saw a slight pullback, but this was to be expected due to the increase in capital expenditures that management said was completely expected. Now, the reason we're seeing lots of tech stocks increase their capital expenditures is because they're competing in the expensive AI race, but as a result, earnings over the long term are expected to be growing at a higher rate. So for a stock that's already up 123% in the last 3 years, does it really have more upside potential? Well, we have to remember, we can actually come to a 2029 price target by taking into account 2 different variables. We need to project what earnings per share will look like in 2029, and then we need to project a 2029 PE ratio. So let's start by talking about our 2029 EPS estimate. Now, we can see in 2024, earnings per share is about $11.86, and as we just saw, it's grown substantially over the last decade, and that's absolutely what's expected to continue to happen, as we're about to see. So how do we project 2029 earnings per share? Well, one of the most straightforward ways to find this is to use one of the ticker data features. What we're going to do is pull in the average analyst earnings per share estimate for the year 2029. So what we'll do is we'll use the formula equals ticker data. We'll come over here and select Microsoft. And then on tickerdata.com, if you go to the docs page and look at ticker data attributes and look at the key metrics, you can see a plethora of fundamentals that we can pull directly into our spreadsheet. But here's the key metric we want, the estimated EPS average. So I'll go ahead and copy and paste that in, the estimated EPS average, and then we'll indicate the year we want it for, which is 2029, close our parentheses and hit enter. And we can see that gives them a 5-year EPS CAGR of 16.96%. So basically 17%. I've seen some estimates closer to 18%. Now we need our current PE ratio. Again, we can use the ticker data live function for this. We'll come over here and select Microsoft and then just say we want the PE ratio and hit enter. And so the current PE ratio is around 37.65, but the 4-year average is 33.35. So basically what this means is Microsoft is trading at a bit of a premium compared to its historic average, at least on a price to earnings basis. So what type of PE ratio can we expect in 2029? Well, the whole goal of this is to be reasonable. It's to not be overly optimistic. In fact, I believe in being somewhat conservative when it comes to price targets. So I don't want to assume a PE ratio in this scenario that's higher than it's currently trading at. Let's in fact assume that it reverts back a little bit closer to around its historic average of 34. All of a sudden, you can see we come to a 2029 price target of $882.64. That would make our 2029 return target about 72% or compounded annual growth rate of around 11.5%. And again, keep in mind, this is not trying to be overly optimistic. Microsoft has the capability to grow earnings at a faster rate, and that's assuming that investors are willing to pay a lower PE multiple in the next few years compared to how it's trading right now. It's completely possible that as Microsoft's business continues to strengthen, as they continue to become a major player in the AI race, that PE multiple could stay just as high or even go a little bit higher, which would start to push those returns closer to that double range. So now we have our first price target. Now let's move on to our second company. The second stock we'll be looking at is UNH. So let's go ahead and highlight our formulas and drag it down. And again, this data will load in thanks to ticker data. Now, obviously, UnitedHealth Group has been on quite the ride in the last year, as you probably already know. It's been a rather dramatic company. In the last year now, it's down 40.5%. Year to date, down about 28.85%. But if we look at the last month, it's starting to look a little bit better, up about 3%. And the stock is now up from its lows where it was trading around $235 per share. So it's grown substantially since the beginning of August. The stock has been in the midst of a lot of controversy, but at the same time, we're seeing insiders buy, we're seeing politicians buy, and Warren Buffett even recently added this company to his portfolio. And on top of this, historically speaking, this has just been a phenomenal dividend growth company. Right now, the company is yielding around 2.4%, but a 10-year dividend CAGR of 16.5%. That's just phenomenal dividend growth. They're growing dividends at a high rate, and it's been backed by growing free cash flow. So what type of price target can we create for UnitedHealth Group? We can already see that earnings are essentially projected to double by the year 2029, and 2024 is about $15.64, which, to be fair, it was lower due to the one-time cybersecurity attack, but 2029, $30.56. That's a 5-year EPS CAGR of around 14.33%. So growth that's getting close to as fast as Microsoft. Now, here's where things get really interesting for this stock. The current PE ratio is only 15.57. On average over the last 4 years, it's been 26.61. Why has there been such a change in the PE ratio? Well, it's important we remember our sources of returns. When we look at a stock and we see, wow, this company is down 40.5%, we need to be asking ourselves, is this due to earnings dropping? Is the company generating less revenue, less earnings, less free cash flow, or is this due to a drop in the multiple that investors are willing to pay? Now, in the case of UnitedHealth Group, like I mentioned, earnings did drop due to the one-time cybersecurity attack. You can see right here, earnings were growing at a very healthy rate every single year, and then the one-time cybersecurity attack cost dropped it pretty substantially in 2024. But 2025, 2026, as we're already seeing, especially by 2029, it is expected to recover. So the huge reason for the sell-off is really a change in sentiment. That's why we saw the stock trade as low as $235 per share at one point, literally just a few months ago. But we're starting to see sentiment shift. Again, insiders buying, Congress has been buying, and Warren Buffett recently added it to his portfolio. In fact, this was the most frequently bought dividend stock by super investors in the most recent quarter. And if you're not familiar, super investors are investors with over $100 million in assets under management. So to me, that tells me that the big money sees this as an attractive risk-reward scenario. They don't think that the Department of Justice is going to find anything with their investigation, and so far from the news that I've seen, it doesn't look like they have. So what does that mean for the PE ratio? We should expect the PE ratio to expand. The multiple should expand closer to its average over the last few years. So let's assume that PE ratio doesn't climb all the way back up to the 4-year average. Let's put it somewhere in the middle, maybe around 23. All of a sudden, you can see that would give us a 2029 price target of $702. We're now talking about a return, strictly based on price movement, of 95%, and that doesn't include dividends, which will add substantially to the total return because it's already yielding about 2.39%, and they grow dividends at a double-digit rate. So this would give them a compounded annual growth rate through 2029 of about 14.32%. So again, another stock with tremendous upside, strictly based on hard data, based on average analyst estimates and somewhat reasonable PE ratios. Yes, this could be a little bit lower, this could be a little bit higher, but the upside is clear. So this is interesting. One stock that's already up a lot in the last year and one stock that's down a lot in the last year, and they both seem to have tremendous upside. Our third company that we'll be creating a price target for is Texas Instruments. So again, we'll highlight the ticker data formulas and drag them down. And we can see out of the 3 companies we've looked at so far, Texas Instruments is actually projected to grow earnings faster than the other 2. 17.08% EPS CAGR. Now, if you look at Texas Instruments over the last few years and just strictly look at the numbers, you'll likely be concerned and a little bit confused. What we can see when we look at Texas Instruments is pretty good earnings growth from 2014 to 2022, really excellent earnings growth to be honest. But then it's been declining pretty dramatically in the last couple of years, and it's even more concerning if you look at free cash flow per share, which has dropped off a cliff in 2023 and 2024. Why has this been the case? Well, it's actually pretty clear if you look at their investors' presentation. Capital expenditures, which we can see in the gray, has risen dramatically in the last couple of years. And remember, capital expenditures lowers free cash flow. Now, why are they doing this? Well, they're continuing to higher their investment levels in 300mm wafer fabs to strengthen competitive advantage. And we can see the type of advantage this is actually going to give them. Compared to the 200mm wafer, gross margins should increase pretty dramatically, going from about 60% to when this project is completed around 68%. So we're talking about a much better product that'll have much higher gross margins, much lower cost to produce them. This is why capital expenditures is so much higher, and it looks like analysts are expecting this is about to start paying off. Now, Texas Instruments is unique because look, yes, earnings is expected to grow at a very high rate, but we can see the current PE ratio at 31.86, quite a bit higher than the 4-year average PE ratio. Now, part of the reason this is the case is, again, because earnings have dropped so much in the last couple of years. But a stock that's projected to grow at 17% absolutely warrants a higher PE ratio. PE ratios are often determined by things like the predictability of cash flows, how fast those cash flows are growing, and just how does the actual quality of the business look as a whole, at a higher PE ratio than they have on average over the last 4 years. So again, we don't want to be overly optimistic, but let's assume the PE ratio falls back just a little, maybe down to about 28. All of a sudden, we can see our 2029 price target at $322 per share, giving us 85.6% upside strictly from share price appreciation or compounded annual growth rate of 13.17%. And on top of this, keep in mind, Texas Instruments is a big dividend payer. In fact, the starting yield right now is over 3%, and they've been growing over the past decade the dividend at a double-digit rate. Now, it's slowed down a little bit in the last couple of years, which is to be expected due to the fact that capital expenditures is higher, but when you consider the 3% starting dividend yield and dividend growth, along with the upside potential, this is easily more than a double through the year 2029 if they're able to achieve the average analyst estimate for earnings and also trade at a PE ratio of 28. And finally, we're going to take a look at a stock, Novo Nordisk, but we're going to look at the ticker in their home country. So again, let's go ahead and drag our formulas down. Now, Novo Nordisk is a very interesting situation. Look at the share price in the last year. It's down by about 52.7%. Year to date now, down 34.13%. But if we look at the last month, it's finally traded somewhat flat, but the price movement has definitely been pretty choppy. Now, we do need to make note that if we look at the yield right now for the trailing 12 months, it's sitting at about 3%. So another stock with a decent starting dividend yield that's historically had pretty high levels of dividend growth. If we go ahead and jump over to our stock screener, let's take a look at Novo Nordisk. And just look at the earnings growth, especially in the last few years, 2020 at about 9, and then in 2024 all the way up to 22.67. The same has pretty much been true with revenue per share and free cash flow per share. And just look at the return on invested capital for Novo Nordisk. Now again, this is essentially telling us how profitable are the projects they're investing their capital into. As a baseline, we want to see around 10%, and the highest quality companies can often achieve 20% or more. Well, typically, they've been around 40% or more. That's extremely impressive, and part of the reason is because of their capital light business model. For example, if we jump over to our profitability sheet, just look at the profit margins they're getting. The 10-year average gross profit ratio at 84.1, and last year's at 84.67%, and that profit ratio has been incredibly stable over the past decade while revenues continue to climb. Now, the huge concern for Novo Nordisk, and really the reason that it sold off, is because of the competition in the GLP-1 market. Really, it's coming down to Novo Nordisk versus Eli Lilly. Novo Nordisk has historically had over 50% of the share in the GLP-1 market, but Eli Lilly is really starting to compete. And in fact, if we look at the EPS CAGR projections, Eli Lilly is projected to grow at a very fast rate. Novo Nordisk too, but Eli Lilly certainly quite a bit faster. But with that being said, the PE valuations look dramatically different. Look at this for Eli Lilly. That's their PE ratio for the trailing 12 months versus Novo Nordisk at about 14.4. So definitely an interesting battle playing out in the GLP-1 market. Now, for Novo Nordisk, we can see by the year 2029, the average EPS estimate's about 35.25, which gives them an EPS CAGR of around 9.23%. And that current PE ratio is just radically lower than we've seen over the last 4 years. And for a stock that's still projected to grow earnings at close to double digits, that seems like a very low PE ratio, I must say. Now, part of the issue is the unpredictability of the future in their market. Yes, the GLP-1 market is projected to grow essentially at the same rate as the AI market over the next few years. But who's going to be the biggest winner, Novo Nordisk or Eli Lilly? Because of that concern, a lot of investors aren't willing to consider Novo Nordisk as an investment opportunity, which means the PE ratio is lower, creating more of an opportunity, ironically enough. So even though Novo Nordisk is growing earnings at a rate far faster than the S&P 500 as a whole, they're trading at a PE multiple radically lower than the S&P 500. So if that PE multiple jumps up to around 20, which is absolutely possible in my opinion, still far lower than the 4-year average and very reasonable for a stock growing earnings at about 9 to 10%, we can see all of a sudden the 2029 price target would be 705 with a 2029 return target of close to 96% or compounded annual growth rate of 14.35%. Now, again, keep in mind these numbers that we're looking at are not in US dollars. We're looking at the home country's ticker. Keep that in mind. But the return target of 95.5% would still apply if you buy the US ticker. And like we saw just a moment ago, the yield is around 3%. So in reality, you'd be looking at returns well over 100%, more than a double. So again, it's important to note, for the 4 companies that we looked at today, we didn't create price targets out of thin air. We had a very straightforward methodology, in fact. We took the average analyst estimate for 2029 earnings and applied it to what we hoped was a somewhat conservative PE ratio. Yes, it could absolutely be lower, it could absolutely be higher. But even with reasonable PE ratios, we're looking at stocks with huge upside potential through the year 2029. And it certainly provides market-beating returns compared to historic market averages. So next time you see someone give a price target without any context, just go ahead and run the numbers for yourself. Find what the average analyst estimate is 4 or 5 years out. I use ticker data to do this. Again, if you'd like to be able to download any of my spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.